The benchmark Nifty 50 index claimed a fresh lifetime high of 22,187 on 19th February after a stupendous 500-point rally in 5 days. Meanwhile, the BSE Sensex index has leaped little over 1,600 points during the period. Analysts believe the general euphoria on the street has resulted in dangerous obsession with superficial narratives at the expense of fundamentals. Meanwhile, the mid and small cap indices have rallied over 60% each on the NSE in the past 1 year as compared to around 23% rise in the Nifty 50 index.
Frankly, not at all comfortable with the market valuation. It's gotten a bit too expensive, especially on the mid cap and the small cap side of the market. However, market is supreme and has a mind of its own, irrespective of what each of us may suggest. So it can still move up further based on liquidity flows. As an investor, I would be extremely cautious, would prefer to be around 25% in cash in my portfolio and possibly look for further profit booking opportunities.
As of January 2024, the latest price to book valuation for the Nifty 50 index was 114% of the average historical valuation. Data by HDFC Securities shows that the last time when this ratio crossed the 100% mark in FY22, the index declined by around 2% in the subsequent financial year. Similarly, the Nifty Midcap 100 is currently trading at 122% of the historical price to book valuation. The previous peak was made in FY15 at 129%, post which the index declined by 4.2% in the subsequent financial year. As for the Nifty Small Cap Index, it is currently trading at 149% of its historical price to book valuation, surpassing its previous peak of 125% made in FY21. In the last decade, this level of overvaluation in mid and small cap indices has not always resulted in a sharp index correction in subsequent 1 to 2 years, HDFC Securities notes. Given this, what should be your investment strategy?
Cherry picking at this point of time is extremely difficult as the stocks are overmined. Valuation wise, opportunities are very limited. However, it's a huge opportunity for traders as there is momentum in many pockets. So if one plays these opportunities with a discipline of a strict stop loss, I think there is good money to be made.
Stock-wise, Bandhan Bank, Crompton Consumer, Aurobindo Pharma and City Union Bank are the top buy ideas by HDFC Securities. On the other hand, stocks that are more stretched versus historical valuations are Tata Motors, Nestle India, Titan and Britannia. Analysts do not expect a sharp correction in the markets just yet, especially if the Bharatiya Janata Party was to win the forthcoming Lok Sabha elections in 2024. However, they believe the disconnect between fundamentals and valuations does ring alarm bells. Today, on 22nd February, minutes of the US Federal Reserve's latest policy meeting, along with stock-specific actions, will sway the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.